Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Welcome to my podcast. Okay, a lot to talk about. Now, today the market's up a bit. Why? Well, they're taking a rest. That's why we're having a little bit of a pullback in the yields. That's not going to last. It will only last if oil can get to $75. We need to get oil down to $75 to get rid of this craziness that we have. And what's the craziness? When you're above $75 in oil, you have yields that are going the wrong way. They're going up, but the storytellers on CNBC and Fox Business always say, oh, this is a great thing. Yields are going up. That's a wonderful thing. That means the economy's doing well. I mean, jobs are doing well. I mean, I heard this guy today shows strong growth, he says. Really? Narrow credit spreads, really? Increasing productivity, all lies. He was talking about it today, like he's just sitting here lying. Now, when yields are up, that's what it's supposed to mean. But what if yields are up and we're in the condition we are now? Are you kidding me? When you have yields going up for the wrong reasons, we have an oil shock, and yields are again going up because of the demand from the bond people. The bond people want higher yields. You can't blame them because inflation is going up. So, but what Wall Street will tell you and the TV jibber jabbers will tell you, this is a good thing, yields are going up. That means that things are great. It doesn't mean that at all. When yields are going up for the right reason, yeah, we have strong growth, we have strong productivity, we have strong jobs, but we don't have that. Now, I'm going to play a cut for you. Listen to this guy. Go ahead.
As of February 28th, the morning of February 28th, the U.S. economy was in good shape. Still had growth that looked to be about 3%.
These guys, it's unbelievable. So here's the real story.
The GDP, fourth quarter, second time around the block. Our headline number, it gets cut in half. From 1.4 to 0.7. That would be the weakest growth in any quarter since the first quarter of 25.
All right, so let's put it together. As of February 28th, our GDP was 3%. The recent GDP is 0.7, 7/10. 7/10. What are you, nuts? Now, we have 104 million Americans, this is a record, are not in the labor force. 104 million. Now, this is not a statistic. This means the economy's breaking underneath. I keep telling you, you watch IWM, the small mid-cap stocks, they're the truth. The bond, the yields, and IWM are the truth serum. You go to either one of those and ask what the economy's doing, they'll tell you the truth. IWM, the small mid-cap stocks, have been telling us for a long time, we're in deep trouble. We're in deep trouble. And the yield's going up for the wrong reason, we are in deep trouble. But you won't hear that on any of these news jibber-jabbers. So it means that we have cracks spreading in our economy. We have a foundation that's ready to collapse. Now, 104 million Americans are in the working force. So someone say, well, so what? Well, that includes retirees, students, stay-at-home people, disability workers, discouraged workers, people who simply left the workforce and they're never going to go back. That's the largest number in the U.S. history. And here's the kicker. It exceeds the number during 2020 shutdown. What are you, nuts? This is insane. Since 2008, the number outside the labor force exploded by 25 million. Now, this is the era of QE, zero rates. Remember that? This is where everything's zero rates, QE. The market's never going to go down. Every time it goes down, the plunger team comes in and brings it right back up. This is the era of asset inflation. Tech stocks, AI, mega cap stocks. A handful of stocks holding them all up. This is crazy. The labor market has never recovered from the financial crisis of 2008. Why do you think in 2008 they did what they said, we got to do something? And that's when they came in and said, look, we're going to print $13 trillion. Imagine just print it out of thin air, and we're going to give it to the institutions. And why did they do that? Because they no longer could have institutions, no longer could have fundamentals controlling the market. You can't have that. So so they changed it. That's the last thing they wanted. So, and so again, remember, the Fed decided then they're going to control the source of liquidity. The institutions will control the direction of the liquidity. Now, there's stock movement and price. Before, it was fundamentals who controlled the price, the direction of the market. If the stock went up or went down, it was the fundamentals. It was storytelling, lying. It was all about storytelling, because storytelling was a wonderful thing, because they can control the market with stories. That was gone in 2008. So when you hear about liquidity, everybody gets confused between liquidity and cash. So let me straighten that out, because this is really important to understand if you're in the stock market, what goes on, how the market really works. So when the Fed controls the source of liquidity, the source, that means it's controlling the yields, the credit. So in other words, think of liquidity as this: low yields, easy credit, low funding costs, tight spreads, which tight spreads just mean easy credit. Okay, so the market, the way it works is when the market goes up or down, it depends on the condition of liquidity. So in other words, who makes the decision if the market's going to go up or the market's going to go down? The 13 institutions. Now, what do they make that decision on? Well, the direction of the liquidity. Now, what's liquidity? It just means, do we have low yields, easy credit, low funding costs, and tight spreads? That's what drives the market. So institutions, when the Fed in 2008 electronically printed $13 trillion, they injected it into the 13 institutions, that was the moment, and they had no choice. They had to make sure no longer would we be taking the stock market and let it be controlled by storytelling. But storytelling was a wonderful thing. You could move anything up with a story, because you could control the investor by telling him a story. You can control the emotion. So instead of doing that to save our financial institutions, they had to stop with Wall Street telling stories to move the market. But they still do it anyways. So if you're going to have, let's take the institutions. They want to move a stock. So they're going to make sure the institutions will move the stock up or down based on the liquidity conditions of, do we have low yields, easy credit, low funding? So before they move, if they're going to move a stock down, they go, okay, how are we doing with the conditions? Do we have low yields? Oh, no. Do we have easy credit? Oh, no. All right, then we can't move the market. If we're going to move the market, then we better have low yields, easy credit. They control that now. And this is where everybody's getting screwed up with the market. Because you got one side of the market, we're still being controlled by storytelling. And that's how they mask, like, all the information I just gave you a moment ago. They'll mask all that by telling a story. For example, gold. Gold miners want to go down. Why? Why will gold miners go down? Because the yield's going up, but they're lying and saying yields are going up. That means we have a great economy. So you hear all the jibber jabber. Yeah, yields going up. We've got a great economy. Technically, they're right. If yields go up, you're supposed to have a great economy. But what if the yield's going up and you don't have a great economy? And we don't. I just went over the numbers with you. How's that a great economy? Well, by telling stories, they can mask it. But your stock is going to go up and down, not by stories. Your stock goes up and down by the 13 institutions will make a decision what stocks will go up, what stocks will go down by what. If the conditions of our yields, are our yields low or high? Is our credit tight or not? Can you get a loan? Yes or no? Tight? No. So that's what's driving the market, and nobody gets that. So you have two forces. You have the pure force that wants to move the market correctly based on, do we have low interest rates? Do we have low funding costs? It's the way a market should move. It should move if only we have, good credit, good funding costs, easy credit, low yields. Then you move the market up or down or stock up and down. So what happens is the institutions will make that decision. And then what they'll do, that liquidity will go into the pipeline to go to the stocks you buy or sell. So they're going to push that liquidity, or it's not cash now. They're going to push that liquidity, which is low yields, easy credit. Think of it as they're pushing that through pipelines to go buy a stock that you want. Okay, so the institutions want to buy stocks, so they'll push the easy credit, the low funding, that will go through these pipelines to go buy tech stocks or go buy real estate stocks, whatever. So that's why take for example, right now with the gold miners. Now the gold miners is a big opportunity with the gold miners to short. Okay, now, and here's what's going on. So, as I said, Wall Street has trained the public to rely on storytelling and fundamentals. So the fundamentals, have stopped driving the price. But people don't realize that. They still think it does. So when you are buying, like for example, we're seeing right now the liquidity coming out is starting to decline. What's that mean? You're starting to see that our yields being low, no more. We're going to be going up. Our easy credit, that's not going to be easy anymore. Low funding costs, are you kidding? That's going up. Tight spreads, that's not going to be tight anymore. So the real world is, we know that liquidity is coming out, the stock market's going to go down. But what does Wall Street do? Wall Street's going to tell you a different story. The jibber jabbers are going to go out and tell you how everything's terrific. They'll feed you a narrative, a fake narrative. So when they see the liquidity tightening, and stocks should be going down, everybody should be on that bandwagon. But they stop it from going down by creating a story. Everything's wonderful. Everything's great. I mean, take a look at the labor market we just went through. The numbers are terrible, awful. So just look at the miners. When liquidity is drying up, so that means our low yields are drying up. Our yields are too high. Our easy credit's drying up. Credit's going to get tough. Low funding costs, going to be expensive, going to go up. Tight spreads are going to widen. So, but Wall Street will take it, and they see that liquidity is drying up, but they're going to tell you a different story. They're going to come up with a story with fundamentals and some story to make you think everything's fine. So you'll go in and start buying the miners. Then all of a sudden you get blindsided. You're in the miners. All of a sudden you think you're doing well. They're pushing it up, and then it collapses. So once you learn how the market, you got to almost teach everybody all over again how the market works. You just got to keep remembering who controls the market. It's not the storytelling, okay? The Fed controls the source of the liquidity, meaning low yields, easy credit, and the institutions control the direction of that liquidity. Once you know that, you're going to know which way the market's going to go. See you on the charts.